Hey guys, it's been a while. Welcome back to More Micro. In this video, we're going to talk about an application of the triangle inequality to economics. Let's go. So recall that the triangle inequality states that for 2 points in a metric space, that the distance between x and z is going to be less than or equal to the distance between x and y and the distance between y and z. Based on the property of absolute value functions, we can write this in two different ways. Either x minus z is less than or equal to x minus y plus y minus z, or z minus x is less than or equal to y minus x plus z minus y, where d is, of course, our distance function, which is just the distance between 2 points in a real number space. This tells us a lot of information about geometry, specifically of what is the shortest distance between two places, and distances between points in a real number space. But what can we use this result for as a direct application rather than a tool for writing proofs in economics? So in terms of having a model to go and illustrate this use, consider the case of two different stock investors, a long-run investor and a short-run investor. The short-run investor could be thought of as a day trader. They both invest in a single asset which follows a stochastic process over time, and they both buy it at time zero. The difference between the behavior of these two individuals is the following. Our long-run investor sells his asset at some time t, meaning after purchasing it in our initial period, he's going to sell it again at some time t. And our day trader sells this asset and rebuys it again in the next period at the price at which it was sold at. Though this seems pretty absurd, we can say in this model that if there was more than one asset, this guy goes and invests into an asset which fluctuations as a process have the same expected value as the asset we are considering. This continues until some time t. We can say, based on this process and this trading behavior, that our changes in terms of the fluctuations in the return on the market for our long-run investor will be less than the fluctuations for our short-term investor. So just as an example, just to illustrate this real quick, consider the case where we have a sequence of prices defined over 3 periods. By application of the triangle inequality, we can go and say the following, that the difference between the changes between $1 and $3 is going to be less than or equal to experiencing the fluctuations of the differences between 7 and 3 and 1 and 7, right? And by declaring the left-hand side our long-run investors' return and our right-hand side our short-run investors' return, we see that this result goes and holds. So this may seem like a cute trick of sorts, but I think this can be useful as a tool for explaining who exactly is experiencing the ups and downturns of financial markets the most intensely. It also tells us that long-run investors are more insulated systematically from both the losses and the gains from financial markets than our short-run investors, and those that play the market experience the fluctuations more intensely. It also says that intermediate downturns don't impact the welfare of long-run investors, only those that trade sequentially. So that's the video. I hope you enjoyed it. Let me know what you thought. Is this a good idea? Is this a bad idea? Let me know in the comments below. Take care.